Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Rahul Arora, CEO, Institutional Equities at Nirmal Bank, joining in. Rahul, welcome to the show, and always a pleasure to speak to you. Rahul, my first question coming to you right now is taking how the economy is functioning with the anticipation of what growth could look like. There is a complete disconnect with what the GDP numbers are showing you, whereas what the stock markets are showing you, almost seeing record highs every month. How would you describe this current scenario?
Good afternoon, Hiral, and thanks for having me on your show. So I think yes, you're right. It is a misnomer that there is a disconnect between where the economy stands and where the stock market stands. But Hiral, I was just having a chat with one of my colleagues earlier today, trying to explain to them why this could potentially be happening. See, demonetization has changed a lot of things for us, Hiral. The size of the asset management industry today in India is the highest it's ever been in recorded history. And it's, of course, been aided by the process of demonetization. Now, the domestic mutual fund industry alone, Hiral, today is about 33 lakh crores. Right, about a third of that is equity, which is about 10, 11 lakh crores. And even if I take mutual funds sitting on 2 to 3% cash, we're talking about roughly about 20 to 30,000 crores of cash just sitting with mutual funds. You add to that what the insurance companies ex-LIC would be sitting at. And then, of course, you could probably add LIC on that separately. But even ex-LIC, I think that the cash number would be somewhere between 50 to 75,000 crores. And LIC would probably match it on a 1:1. So you're talking about nearly 1.5 lakh crores of just domestic liquidity. And add to that over $10 trillion, which has been put in by the G3 economy since the pandemic started. That's the FI contribution to the global liquidity, if India even gets a trickle of that. So the point here being, Hiral, is that, people have been expecting a major correction for a while, but the fact is that there is so much money sitting on the sidelines is not allowing for that meaningful correction to happen. Even if the Nifty falls 10% from here, it's not the same as a 10% fall at a 10, 11, 12,000 Nifty. From 16,000, you would have people, swooping in like vultures to buy stocks because there'll be this fear of missing out, or what we call the FOMO effect. So I don't think while the economy is running its course, and I totally take your point that it's probably going to take a couple of years, especially for certain sectors like hospitality, aviation, travel, tourism, the gymnasiums, multiplexes, etc., to come out. And a lot of them have either been raising debt or diluting equity. I think this dichotomy is here to stay, Hiral. I don't think it's going to go away. If people are expecting it to go away, just having told you what I have about liquidity, for sure you'll probably have 5-10% corrections in the market. But like I said, its relevance compared to where you would say at 10, 12,000 would be far lesser. And those dips, given the volume of money sitting on the sidelines, would be an opportunity to come in and buy stocks. So expect this dichotomy to continue. And every time you get a correction, if your quality stocks are coming at your price, please go ahead and invest.
Right. So currently, overall, Rahul, very rightly pointed out. Now, the current rally that we are seeing, I mean, yes, there are bouts of correction that did come in. From March 2020, the uptick was mainly taken over by the FIs, the kind of money that they pumped in. This time, if you go to see, do you think it's the DIIs who are fueling the rally, number one? And there is liquidity, at least in the domestic side of the market, to continue this rally? Or do you think there could be major corrections that could come in?
Oh no, I mean, like I said, Hiral, I think the domestic liquidity is a plenty, and let us say we are hit. I think the only thing that could take this market down in a major way, Hiral, is something that we're not discussing right now. And that could be anything. It could be an escalation of the situation in the Middle East. It could be some collateral damage that happens as a result of Biden's infrastructure program in the United States. Uh, or you had a news report this morning that India has transferred 50,000 of its troops to one of our neighboring countries. So it has to be something that we don't know on current evidence, because I don't think COVID or a third wave or a global or a slowdown in the Indian economy has kind of legs to make the market correct in any meaningful way. So I personally don't think that you're right that the DIs have taken over the FIs in terms of their importance the domestic market of late, and sort of the incremental delta, if you will, of the flows has not been as strong.
Mhm.
I think to a large extent, Hiral, if you go back over the last 10 or 12 years, there hasn't been any India dedicated fund globally that's been opened up. We've always got an allocation of an Asian emerging market fund or a global emerging market fund, and those percentages vary depending on where the valuations are in India. So I think the best thing to have happened to India here over the last few years is the importance of DIs that has gone up, which has to a large extent reduced the volatility that the FI inflows and outflows used to cause. So that being said, like I said, I don't think there's going to be any material correction. I'm not ruling out a 10% correction, but like I said, if you were to get a 10% fall also, I would not really call it a correction. It would just probably be an otherwise pullback in a larger up move. The only thing that could knock the wind out of this market is something that we're not discussing today, and that could potentially have the legs to take it down. But hey, you really can't talk about the unknown when you don't know it.
Absolutely. And overall, Rahul, with all of this, if you have to compare India to other developed economies right now, or for example, even to what's happening in the US markets and the European markets, what would you make in terms of valuations?
So, Hiral, when people talk about valuations in India, they're always looking at three buckets, right? They're looking at the large caps, the mid caps, and the small caps.
Hmm.
Within the large caps, if you take a look at the last 6 months, I think one of the best performers in the Indian equity markets, fueled, of course, by what's been happening in China and globally, has been the commodities index, which is the metals index in India. And you could have played that through crude as well. If you remember, just about 12 or 15 months back, crude actually had a negative reading to it, and today we're sitting at plus 75. So I think when you look at valuations in India and compare them to developed markets, I don't think that's an apple to apple comparison because they are far more matured markets. I don't think there are too many stocks that you'll find that are trading on the London Stock Exchange or on the Dow or even some of the mature Asian markets like the Straits Time or the Nikkei that are trading at 45, 50, 60 times multiples. I think they're far more mature in the way their multiples are assigned. I'm very sure that Indian subsidiaries of global parents, whether you take a Domino's or a Procter and Gamble or a Gillette, I'm sure that the valuations that their Indian subsidiaries are trading are probably 2x of what they're trading in their home markets. So I don't think it's a direct apple to apples comparison. I think what you get in India, Hiral, is that it is still an underdeveloped market in many pockets. So you do get something called a scarcity premium. When you have only 3 or 4 or 5 or 6 stocks in a particular sector, the market tends to assign a scarcity premium to that. And the market leader in that particular niche sector tends to run away with some very obnoxious valuations. And then, the sell side pretty much tries to keep trying to catch up by expanding their multiples when the earnings itself are not expanding. And, the entire sell side of it is guilty. We're guilty of it at our brokerage as well. We're not able to justify stocks at FY22. So you rolled over to FY23, very soon you'll be finding people rolling up to the average of FY23, 24, and before you know it, they would have rolled over to FY24. That's not the fault of the sell side analysts. It's just that the liquidity force is so strong, and fund managers are coming and buying their favorite stocks in such gusto that even though the earnings delta may not be very material, the sell side analyst has no option but for him or her to increase their multiple on the stock that they're tracking. So I don't think it's an apples to apples comparison, but I've tried to probably put in context as to why some stocks or sectors are having slightly what you would call perverse valuations compared to the rest of the market.
Right. So with all of this, now, Rahul, the kind of return and bounce back that we've seen in the mid caps and the small caps from March 2020 to now, I mean, it has been a spectacular journey for them. Do you think now is the time where we will start seeing consolidation and correction in the broader markets, and the rally which will go through or the up move that will continue will mainly be from the large caps?
It's an interesting question, Hiral, and again, it goes back to the point of liquidity. And I'll give you a classic point, case in point. We have a company under coverage called Dixon Technologies. I remember when the stock went to 3.5, 4,000, we started debating on what multiples we wanted to give it. We had a similar conversation when the stock was at about 8 or 9,000, at 14, 15,000, and then it went to 20, and then it went to 25. And, we were just totally clueless on how to, value this company along the way. The same thing has happened in specialty chemicals. A lot of talk about this China plus one strategy that globally people are speaking about. A lot of the manufacturing bases that may potentially shift from China to India, and the kind of multiple re-rating that you've seen in the specialty chemical space. Even at our broking firm, We've got names like Naveen Fluorine, SRF, Fine Organics, Rosari, Galaxy Surfactants. These have been multi baggers. I mean, if you got into these stocks 2 years back, you've made what, two and a half, three times, four times your money in some of these names. So I think what you suggest is right. They may actually go in for a time-wise consolidation. It goes back to the point of liquidity. I don't know how much of a price correction they will see, because today, if I'm a fund manager and I'm coming out with an NFO, or I'm getting incremental money and I have comfort with a particular stock, I will go in and buy that stock. Another case study could be Bajaj Finance. People are justifying the stock at 7 times, 8 times. You never know at what price to book this stock will tap out. But it's just about how you view a particular stock. Bajaj Finance over the last 4 or 5 months is now being viewed as a fintech company. So it's all about how perception to a particular company changes, and whether the underlying fund manager who is holding that stock, whether he or she wants to keep going in and buying those same names. So I do take your point that there will probably be a price-wise, a time-wise consolidation, but I don't really see, unless it's a stock that is not backed by a good management or proper fundamentals, and that has, we have a phrase in Hindi which we say, "Behti Ganga mein haath dho liya." So if a lot of good stocks have been going up, and a few not so good stocks have been going up, that's where the risk is. But where you have good managements, good quality of businesses, at best, I think you'll get a correction. I don't think you'll get a crash. I do think there's a case for the large caps to outperform. I genuinely believe so, especially for the consumer staples. That sector has done absolutely nothing for a year. But I think their time will come. I think people are just looking for a little more sustained outlook on volume growth. And I think you will see a little bit of re-rating that will come through in that sector. I totally buy your point. If I was logically taking a call for the next 6 months, I would say the large caps will probably outperform mid and small caps. But the power of liquidity, I think it is very possible that they move in tandem, or that trend of mid and small caps continues to outperform. My hunch is more towards large caps. The market may take a totally diametrically opposite view.
Right. And with this, Rahul, overall, which are the sectors do you think could be outperforming from here on, taking into consideration that FY21 earnings are already out? Plus, now everyone's talking about the third wave. There has been a slight impact of the second wave on the first quarter of FY22 as well. So, taking the current situation, what are the sectors you would advise?
So, I think, Hiral, if you take global growth as a benchmark, and what the United States is looking like in terms of a growth outlook for the next 12 to 18 months, I think the one sector I would blindly bet on is IT. Because Indian IT services have a very large exposure to the United States. And I think, we'll be incremental beneficiaries of digitization, artificial intelligence, and the Indian companies that have invested in those capabilities or made acquisitions to those effects, I think will stand to benefit in a material way. So I think that is one sector where you'll probably see a disproportionate, returns if you find that the US growth sustains. So that is one aspect. The second is, I think the government of India's focus on infrastructure here, particularly on the road side. I think, you've recently heard a lot of talk about fast tags and moving to toll, sort of doing away with tolls and sort of getting people, to traverse more on national highways and things like that. And the quality of roads has also gone up. And the awards that have been given out to companies, even under our coverage, we track companies like Ashoka Buildcon, Sadbhav, PNC Infra, KNR Construction. So it's been very strong. So I think, road infrastructure could be a very, very significant place where valuations are not outrageous. The third, which is a no-brainer, Hiral, is what we call the opening up trade. You alluded to the third wave. See, we're not doctors here. Let's just assume that we don't have an as bad third wave as you've had over the last 15 months in terms of wave one and wave two. Then I would pick industry leaders in any of the opening up themes. So I would look at an Indian Hotels, which is the home of Taj. I would look at something like an Inox Leisure, where multiplex will probably come back to business. I would look at a name like Bata, where you have opening up themes, because, we've all spent the last 15, 18 months in our homes. So, you've gone from closed footwear to open footwear. I think once things open up, the trend will shift back. So these are some names. And I think the quick service restaurants, because they have, benefited through the delivery channel in such a material way, and all of the QSRs in India are showing nimble footedness, either, adding to their menu or changing their business model in certain ways, and the market is rewarding them with valuations. So I think that's probably another pocket that I think could be looked at with interest. And the last, I think, where valuations would be in some sort of comfort would be on the gas side. So we like names like Gujarat State Petronet, Petronet
Mm.
LNG, Indraprastha Gas. I think that's another pocket of the market that's not looking outrageously expensive, and there could potentially be some value there. So I think these are three or four pockets where I think even from where we stand currently, you could make investments and see decent returns coming through.
Right. And overall, with all of these sectors and the stocks that you mentioned as well, do you think from here on India is entering a period of a virtuous growth cycle as well? Because a lot of people are saying that in spite of the disconnect that we are seeing between, what the markets are showing you as well as what the growth cycle is showing you, still this is going to be one of the best times that an investor could invest in. Lastly, what would your views be on that?
So, I love using this analogy, Hiral. So, if you need 40 runs of a last over in a one-day international, it doesn't matter whether Yuvraj Singh is on strike or Zahir Khan is on strike. The point being, it can't get worse than it already is. So, when you say, can you get into a virtuous growth cycle, it can only get better from here. It can't potentially get worse. The worst is already behind us. I mean, even if you have a third wave, the worst of the economy, I think anyone with any basic understanding of the economy will tell you it cannot get as bad as it was in the last calendar year. So, the can the growth rates be protracted for a very long period of time? It potentially could, because while you have a base effect which is going to make all your numbers look very rosy for this year, let's not forget next year you're going to be on a normalized base of 2021. So if nothing goes wrong, the first calendar year of actually 2020 hindsight, or 2020 vision, not hindsight, is actually going to be 2023, because 2021 is a base on negative 2020. 2022 is going to be on a very high base of 2021. So it is very possible you get into a phase where your growth rate of GDP is probably moving in a 5 to 7% annualized rate for about 3 or 4 years. But if the foundations are laid right, roads, for example, like I told you, I think once we emerge from this pandemic, nothing can stop us from going at 9 to 10% for half a decade or maybe an entire decade. So I think this is the time to put the bearings in place when things are not going right. And when you do start to see the fruits, I have no doubt that from 2023, 24, if nothing goes wrong, right up to 2030, you could have a potential growth rate of 9 to 10%. So just be prepared for a short term 5 to 7%. But India is still a is a fraction of the size of the US economy. The run growth is immense. Our demographic dividend is immense. The number of people entering the earning workforce is immense. There is no way you cannot be a long term bull on the Indian capital market and the Indian economic story.
Absolutely. That's a very well made point, Rahul, right now. Because right now there's a lot of confusion amongst investors whether we've missed the bus or is this still the right time? But perfectly answered overall. Thank you so much, Rahul, for joining us on the show. Always a pleasure to speak to you and get great insights. Thank you. Speak to you soon again and stay safe.
Thank you for having me.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.